This is the Cash Value Solutions Podcast, where your hosts, Jason Pohlmeyer and Kyle Mann, shed light on little-known money truths to help you take control of your financial future and become your own banker. Subscribe, rate, and review the show, and check us out at cashvaluesolutions.com.
Hey guys, thanks for tuning in this week. Kyle and I are taking another break from the book review, and we're going to go over a few more objections or misconceptions of what people think with the IBC. So where are we going to get started today, Kyle?
Well, we're going to talk about how some people think that the insurance companies take or steal your cash value.
This is something that's very common to hear Dave Ramsey say. The life insurance company only pays you the death benefit. You pay in and pay in and pay in to the whole life insurance policy, but they only give you your death benefit at the end. They keep your cash value.
Yep, your cash is stolen by those sneaky, pesky insurance companies. But really, that is not the case here.
Yeah, I think it's very misleading what Dave Ramsey says about that. And if you actually understand whole life insurance, this is just a little bit technical, and then we'll try to explain this in a very simple fashion. But the cash surrender value of a whole life insurance policy is just the net present discounted value of the death benefit minus the future premium payments paid into the policy.
So if we kind of compare this to a mortgage, let's look at it from the aspect of having a 30-year mortgage. At the end of those 30 years, you go into the bank and you get your title. Well, when they give you your title, they don't give you all the money that you've paid in to them. I mean, why would you do that? You own the house.
They would probably give you a really blank look if you asked for all the money back that you paid in on your mortgage, right?
Yeah.
It's the same thing going on with a life insurance policy. I shouldn't say the same thing, but the same type of principle applying, right? You get the death benefit because of all the payments that you've made into your policy.
Yeah, and if you go along, like before you have the house paid off, you have access to the equity of the house. So that's the principal that you've paid in, which is the same thing as the cash value. The cash value can be looked at as the equity in the death benefit.
Yeah, exactly. That's, like you said, what you have access to. And there's no funny games going on or anything with that. I mean, when you really start to think it through from end to end, it makes complete sense. But of course, when people just say things and you don't understand what whole life insurance is and how it works, it can sound like those pesky life insurance companies are keeping your money and, you're not getting a good deal.
Well, yeah, if you just walk by and hear this, you think, wow, that is horrible. Why would you ever buy whole life insurance?
Yeah, I think that can be not for everybody, but something that isn't understood. So hopefully that provides a good level of clarity to you guys about that. What should we talk about next, Kyle?
Well, if this is just a way to build up cash, why do we use whole life insurance? Why couldn't we use something else?
Well, what do we want to compare it to? Just for the essence of time here, let's just pick something. Should we do a HELOC?
Sure, we could do the HELOC.
Okay. First thing that comes to my mind with a HELOC isn't the home equity line of credit. That's going to be dependent on the market value of your house, wouldn't it?
Yes.
Okay. And so can the bank control the market value of your house?
No.
And if your house would go down in value, would that not affect potentially your line of credit that you have on your house?
Oh, it absolutely would.
So because the bank can't control what the collateral is, the value of the collateral, that's why it doesn't make as much sense to perform the banking function or do the infinite banking concept with another instrument. And we're just picking one thing here to explain. But a life insurance company is contractually guaranteeing you the death benefit. So they're controlling the value of the collateral with an infinite banking policy, right? Mm-hmm. That's why it makes so much sense to borrow against or use a cash value life insurance policy to perform the banking function, to do the infinite banking concept with. Do you have any other thoughts that you want to add with that, Kyle?
I think using or comparing it to HELOC is really relevant because you can hear that around the internet. People say, no, I can just do this with home equity line of credit. But, we experienced this in 2020. Some banks just stopped doing home equity lines of credit. So you don't even have access to it. You couldn't even do it if you wanted to.
Yeah, if you didn't have it set up, or maybe they've even taken away some.
So yeah, this comes back to not having control.
Control, guarantees, liquidity. I mean, those are the three biggest things that you gain with an infinite banking concept policy, right?
Yep.
Is there anything else you want to add on that, or should we move on to the next
Let's
thing?
move on. Okay. This is one that you hear. Well, what happens when the economy crashes? Won't the life insurance companies go down with them?
That's a good question, and I think we have to look at history to try and get a gauge of how to answer this question. Some of the companies, the mutual life insurance companies that we write with, have been around since the 40s or 50s, 1840s or 1850s. They have been through the Civil War, 2 world wars, the Korean War, the Vietnam War, countless stock market crashes, the Great Depression, the Great Recession. And some of these companies have paid a dividend every single year that they have been in business. So that's above and beyond what the contractual guaranteed growth was in the policy on top of that.
Yeah, and I don't think that we can say that, it's impossible for them to fail. I mean, sure, anything is possible, but without what they do, they're going to be one of the last ones to fall. And I mean, they focus on conservative investments, and they also can't do fractional reserve lending.
Yeah, they can't lend out money that they don't have. They just invest what they have. There is no lending money that didn't exist before the deposit was made, correct?
Yeah.
And they also keep surpluses. That's where your dividends come from, actually.
Yeah. So let's move on to the next misconception. Well, doesn't whole life insurance doesn't keep up with inflation, does it?
So let's do 2 examples here, Kyle. Let's talk about when late 70s, 80s. Let's talk about stagflation. How about that to start?
Mm-hmm.
So companies at that time, it took their general portfolios a couple years to turn around when inflation started going up. Interest rates went up before they caught up with that.
Mm-hmm.
But after that, I mean, they had their dividend rates were in the double digits after that, correct? So I mean, yeah, it took them. There was a little lag time, I guess, before they caught up with inflation. But once that happened, they were keeping up with it, and they've maintained higher dividend rates than inflation, or at least reported inflation, than the economy since then.
Yeah, they also would have been locking in some of those higher interest rate bonds, for periods of time where interest rates were low.
Good point. And so then the other thing I think people think of is, well, what about hyperinflation, though? That's what I'm really concerned about. And, I guess I have 2 things to say about this, and then if you have anything, go ahead and add. But so if that happened, first of all, the dollars that you would be paying as premium into your policy would be worth much less. So your premium would be much more affordable to you. And second of all, if that happens, you could take out a policy loan, go and buy assets, real assets, whatever you believe. If gold is what you believe in, you could go out, buy those things, and turn around and pay your policy loans back a year later for pennies on the dollar if we have price inflation.
Yeah. No, I think that covers that one pretty good. Another common one is, well, what about if the tax laws change? And we've seen that before. Like, I think it was 1986, they introduced the MEC laws, which is the modified endowment contract. And the people that had policies that qualified as MECs, they were grandfathered into the system. So they had the same tax treatment as what they had when they were purchased. And I guess that's kind of what we can say, that we would expect is that you'll just be grandfathered into the system. And I mean, we cannot control what Congress does.
We don't have any control about what they do, and we can't say that we know that's what's going to happen. But based on what happened at a previous time, things were grandfathered in. And so, we would believe that anything put in force before another change is made would have the same treatment. And also, even if, it would make no sense because life insurance is a replacement for a loss. But even if life insurance became taxed for some reason, and I'm talking about the cash surrender value now, just because we can access that tax-free doesn't mean that's the only reason that we can do infinite banking, right?
Yeah, it's not a tax gimmick. IBC.
It's just a benefit that comes along with whole life insurance. That isn't why this whole system works.
Yeah, like we said before, whole life insurance was here way before 1913 when the income tax laws.
Great point. Over 200 years, dividend-paying whole life insurance has been around. So we can't control that, but that is kind of our opinion of what we think would happen if some type of change were to occur.
So next topic. Why shouldn't I use universal life, variable universal life, index universal life to implement the infinite banking concept?
Well, I'll just say that with whole life, the guaranteed interest rate will always exceed the insurance expenses. So if you continue to pay your premium, the guaranteed interest rate is going to outpace the insurance expenses built into the contract. With universal life, the mortality charges, administrative costs, and fees will exceed the guaranteed interest rate accumulation over time. Now, that's not to say that we're going to be in a guaranteed rate environment, but it is a reality of the universal life product that should be discussed if somebody wants to purchase it.
Sure, it comes down to it being a tool. Like anything else, it can have a place. So for yourself, you just need to educate yourself on it and then be able to make an informed decision of, hey, do I need this? But we just don't recommend it for IBC because it does not have the solid guarantees that dividend paying whole life has.
Well said, Kyle. And are you ready to move on to the next thing?
Yeah, this is also very common. Well, I'm too old for this, or my health isn't good enough.
So let's talk about the too old thing. When we structure policies and emphasize cash value, whether you're 20 or 30 years old or 50, 60, maybe up to 65 and a little older even, cash value accumulation can be very similar.
Yeah, it's just the death benefit is where the big variation is.
Absolutely, yeah. And to explain why we can have similar cash value accumulation is because an older person doesn't have to purchase as much death benefit to provide room to stay under the MEC line when we're max funding policies for cash value accumulation.
Mm-hmm. And even if you're not insurable, you can still do this. You can, if your wife's insurable, if your business partner's insurable.
Yeah, if you have business partners that you work with, that's
an
excellent candidate.
Your children, I mean, there's a way.
There's likely a way, if you aren't insurable, that you can practice the infinite banking concept somehow. Now, it has to be an insurable interest, but there's likely somebody in your life that you're close with, have a good relationship with. And I should say that just because you have a good relationship with them doesn't mean that you have an insurable interest. There has to be a measurable financial loss to have an insurable interest in somebody.
Mm-hmm. Good point.
So I think that's it for today's podcast. We wanted to hit on some things that it can be hard to get past or understand when you're looking at the infinite banking concept. Are there a few more things you need to say, Kyle? Or
no, I think that in the future there'll probably likely a part 3 to this. I mean, we haven't covered all the misconceptions. These are just some of the most common ones that we run across. So
yeah, we tried to hit on the most popular common questions that we get. So with that, I'm ready to get out of here, Kyle.
Yeah, and if you guys have any questions about anything you've heard, don't be afraid to contact us.
Yeah, send us an email. We'll put those in the show notes page. And we'll be here next week.
This was the Cash Value Solutions Podcast. Remember to subscribe, rate, and review the show. Check us out at cashvaluesolutions.com. And don't forget to tune in next week.